Hi, Dominique, and welcome to Week Ahead. Obviously, this has been pretty important week. I mean, all the weeks, even throughout the summer, seem like they've been pretty important, but this is obviously the one well telegraphed that everyone had been looking for. And if anything, I felt like, the most of the week from Monday to Thursday, the markets were pretty calm and felt like they had a handle on how Chairman Powell was going to handle it. Yeah, what's your take? Let's start with that, obviously. What's your take on, what he communicated on Friday? Obviously, other Fed speakers were also communicating, and obviously the market reaction.
Sure. So you could say that Chair Powell unleashed his inner Volcker. I mean, he was brief to the point and he made himself clear. I'm not sure how he could have been more hawkish. But what is interesting is the market reaction. So equities sold off, which this isn't surprising. Those guys are perennial optimists. I mean, the idea of the pivot never made sense to me. But to me, what is more interesting is the lack of reaction of the fixed income market, because for all this hawkishness and, very strong words, I think the 2-year moved maybe 3-4 basis points, and so did the 5-year. So, I mean, there is this old French song, parole, parole, I mean, words. I think what is going on here is that the Fed doesn't have much credibility when it comes to hawkishness, because we still have cuts priced next year. And I think the loss of credibility reflects a couple of things. First of all, that the Fed...
Did some of that stuff get unwound on Friday?
A little bit, but so the spread between the DEC 23 and DEC 22 contract narrowed, but you still have a spread. So the market is still expecting, I mean, last I looked, the market was expecting from March to December 40 basis points or so of cuts. So I wouldn't call that hawkish. So I think what's going on is that is really two things. First of all, the Fed macro scenario completely lack credibility. They make no sense, because you have a decline in inflation with a negative Fed funds rate and no increase in unemployment. So the market participants saw that and they thought, the Fed doesn't have the guts to do what it takes to bring down inflation. And so that's, the cut started to get priced in after the June meeting, basically. So you had that by contrast with the Bank of England, which is not, 100% open on what's coming, but at least it had the common sense of admitting it's going to be a recession. It's not been telling people how nasty the recession would be, but communications wise, it's a step in the right direction. The Fed, for all, the words in Powell's speech, what did he say? Painful, some pain for businesses and household. He still hasn't used the word recession.
Right. It seems like he's really reticent against using that. Well, listen, clearly, some parts of the market did interpret this as moving a little bit. And I guess if we say that, there's two parents, there's equities and fixed income, equities we're kind of buying this soft landing the whole time. And I almost think the issue is...
The mom is wiser and is a fixed income part of the
always, exactly. But I think the tricky thing on the fixed income, and you're going to know this a lot better than me, which is there is a point when he tries to be hawkish, and the bond market at least will say, whoa, he's hawkish, so we should price out any cuts next year. But he's so hawkish that there's clearly not 0, but not 100, but somewhere in the middle, growing chance of there being a policy mistake or some type of fragility in the system. And that could be triggered by the Fed being, so if that is triggered, they will have to cut. So I guess I'm in the other camp where it's tricky, because if he does talk too hawkish, clearly these cuts should be priced at. He did say, and I think Bostic or others did say, it will have to, raise rates to like like somewhat restrictive point and potentially be there for a significant period of time. So yes, in that case, there's no reason for any cuts to be priced in the next 18 months. But I think part of the market still sees the chance of a mistake and actually, a very heavy, a very deep recession. So not even a question about recession. And I was talking to Bilal, I think on Thursday, which is, me, you, Bilal, we've seen a lot, more than just cost by nature being in the markets for a long time.
It's not our first rodeo.
It's not our first rodeo, exactly. And but one of the things is that investors are so colored by 2008 that there's no such thing as a kind of a drawn out recession or a medium or that there's always some giant Lehman there now lurking, and that's kind of been in people's psyche now for the past 10 years. Maybe it's slowly going away, but I think most of us agree the amount of probably easy money and have to be extra leverage that's gone into the global economy in the last 10 years. I mean, I think we all agree, we've never had this much negative interest rates in the world. Like, there were dumb things that were made, Now, have a lot of that stuff been locked in on medium to long-term liabilities that don't come up, that are not sensitive short-term to movements? Maybe, but I think that's one of the things that, to me, that seems like it's getting played out.
So fair enough, but I would say that when Lehman happened, at least in the run-up to Lehman, inflation was 2% and the Fed funds rate was 5%. So we're talking about a 3% real Fed funds rate. Right now, we have a negative -6 something Fed funds rate. So, if we had the equivalent of the Fed funds rates leading to the crisis, I mean, I wouldn't be forecasting 8%. I would be forecasting 11%. So it's different. I would also argue that, again, it's poor communications on the part of the Fed. They have spent so many resources on risk, on containing risk. They have pushed through regulatory reforms, in my view, excessive. In my incentive structure has not changed that much. What has changed is that banks find it very hard to function as banks because there are so many regulatory constraints.
Right. And instead, that extra risk is now passed on to private lending or PE or whatever,
Exactly.
Or other kind of shadow banking, which is probably worse, if anything.
Yeah, I would argue
maybe different.
Don't have the systemic impact of banks, because the reason banks, always get these handouts from the government is they handle transactions.
Yeah.
So I remember when I was working at RBS, a senior RBS manager telling us that no matter what, we would get rescued because I forgot the share of UK transaction going through the RBS balance sheet. So that hasn't changed.
Yeah, that's a good point. Right.
Um,
And if like Carlisle went under Apollo or something, it would be bad for the markets, but it may not be.
some very wealthy people would get a little less wealthy. I'm not sure it would have a big impact on the economy.
Right. But it's a good point. I have not heard of that about how important it is from just a functioning system, functioning economy, things like transactions. So why did you think equities took it so negatively? By the way, it's one day, and we've seen these type of episodes in the last kind of 8 months where you have Fed saying something, the markets take it very negatively, and then they kind of digest it, and there's still a lot of money on the sideline, and it comes back in.
Sure. Well, I mean, as you said yourself, equity investors are more exuberant. It's a dad in the parenting couple.
Yeah.
I think they just had unrealistic, I mean, they got used to a decade or more than that, almost 2 decades of Fed put. And now the Fed put is no more because we are in a higher inflation environment. And it's very hard to let go of something that's been so good, zero cost, no risk, all return. So I think there will always be a bias on the part of equity investors to look for Fed dovishness until the Fed convinces them that it's not going to be the case anymore.
Yeah.
And again, it comes back to the internally inconsistent macroeconomic discourse of the Fed. If they want to convince the market, they should, come up with a convincing story with what they have right now in their SCP. And a big test, by the way, will be the SCP, the changes in the SCP in September. What they have just confuses everybody because, Chair Powell says that things are going to get very, really painful. You look at the SCP, over 2 years, the unemployment rate increases by 40 basis points. Come on, guys. They have to do better than this.
Yeah. No, it's interesting. I also think, and I haven't really heard it from anyone but you, that when people are confused why the market was reacting and pricing and cuts next year, and forget about that there's going to be a big recession, that's why, but really they just didn't buy that the Fed was serious, is because your point, which is, yeah, he says he wants to be Paul Volcker, but he keeps talking about a soft landing. So if you really listen, and I think the reason equities sold off so much was because this was the first time he's like, well, it's not a soft landing. In fact, may not, okay, he didn't use the R word, but it may not be great. And there may be some pain. And I think equities were like, whoa, even though we all agree that he should never have been talking both, as I think you said in one of our previous ones, both sides of his mouth by saying that.
Totally. So under the test is going to be whether it changes the path of unemployment in the September SCP. And one of the things that he was getting at, obviously, and which George, so Kansas City Fed President George had mentioned the day before or a couple of days before, is a lack of tightening of financial conditions. And this is a direct reflection of the fact that the market doesn't believe the Fed is really going to get tough. So it's good to talk, but now, show us the money, show us the SCP. Otherwise, we will be in that situation stuck in a limbo where, the US economy, we're going to talk about the data in a little while, but the US economy is not slowing much, and there isn't much tightening happening on the fiscal side, because for all intent and purposes, fiscal consolidation is over at the end of September. I mean, the budget deficit is expected to be roughly the same next year and this year, even though unemployment on average will be lower or will start with a lower unemployment rate. So on a cyclically adjusted basis, actually, fiscal policy will be looser. So let's get real. If you are the Fed, you mean to tighten, and show us an increase in the Fed funds rate trajectory, and show us what you really expect to happen to unemployment. Otherwise, we'll get stuck in that limbo where you have the 30-year mortgage moving between 5.5%, financial conditions index not moving either, and basically inflation, the economy and inflation getting more momentum, and the ultimate, the unavoidable recession getting more painful by the day.
Yeah. Okay. Last one I wanted to ask was this Jeremy Siegel. I don't know if you saw some of his comments.
No, not.
Was it Jeremy Siegel? Maybe I don't know if it was Stiglitz as well, but like this more liberal view, which is maybe the Fed, if a lot of it is because of supply constraints, and hopefully those supply constraints will, and things like input, like energy, which we all agree the Fed, can't print oil. That maybe the Fed should go slower because some of these things are out of their control. It's not necessarily demand issues.
So, I mean, with all due respect to Joe Stiglitz, with the Nobel Prize in Economics, this is economics 101. You have the demand curve that is going down, the supply curve that is going up, or maybe is completely vertical. So supply curve shifts. As you said, there's nothing you can do about it, not the Fed. And so what happens if you don't bring down demand in line with the reduced supply? Inflation goes up. And when inflation goes up, everybody feels the pain. I mean, wages adjust with a lag. People who are paid minimum wage have even less money. I mean, the minimum wage in most of America is not a living wage. So those people who are already relying on government handouts, who are already experiencing economic hardship, they have even less real purchasing power. I mean, and as Powell said, if you don't control inflation, if you don't prevent inflation, if you don't bring down inflation, it will accelerate. Because, and there was a really nice paper from the BIS, which fortunately or unfortunately Joe Stiglitz hasn't read, which shows really good empirical evidence. Maybe empirical evidence is not what he's interested in, but it shows a difference in momentum between low inflation and high inflation. Low inflation has a lot of inertia and tends to stay low. High inflation tends to accelerate. Why? Because what drives the difference between low and high, as far as inflation is concerned, is behavior. Once inflation starts impacting your behavior, like your wage setting, your price setting mechanism, then it can only go up, because what happens is that employees ask for more money. Not only they ask for more money, but they ask more often. Like typically wages are agreed once a year, maybe twice a year. But when inflation goes up, wages get bargained more often. And so they become more responsive to prices. And so what happens is that if you have a shock, the same inflationary shock will have a very, very different impact on inflation, whether you start from a low inflation regime or a high inflation regime. In fact, this is one thing I want to write in my next weeklies. If you look at the experience of inflation, once inflation is above 5%, it's much more likely to go to 10 than to 2. So with due respect for Nobel Prizes, economic, academic credential and all that, it doesn't make sense.
Right.
Anyway, my uncensored opinion.
Okay. Okay, and then on quick one on the week ahead, I guess will the Fed continue hammering that message?
Of course.
Or do you think by seeing the reaction to the equity market they kind of feel like, okay, we gave our message. It was the markets heard it. And then obviously, what are the other things you look out for this coming week?
So briefly on the Fed, I am hoping that they will pay more attention to the fixed incomes and to the equity market.
Yeah.
And so they'll continue to on the same tune.
The markets are now saying that the Fed funds rate should get close to 3.8%, right? And then start dropping down from whatever March.
Right.
Okay.
Right.
Fine. I'm just looking at it on Bloomberg. Okay.
Yeah. Okay, so for the rest of the week, NFP, of course. And there again, I fear the market is a little too pessimistic. I mean, one of the things that caught my attention over the past couple of weeks was claims. You know, I've been saying for some time now that the increase in claims was not matched. The increase in initial claims was not matched by an increase in continuing claims, which shows that people found jobs quickly. But for the past couple of weeks, claims have started to go down. So maybe just a statistical quirk. But if not, it suggests that the economy is gaining more momentum, which
is
you've
been saying,
and which is the opposite of what the Fed expects. I mean, in the minutes of the July meeting, the consensus was that the economy would slow below potential in the second half, and I fear it's more likely to accelerate than to slow. So there again, I mean, let's see how the Fed reacts. But I think it's not so much about words now; it's about deeds. So they have to show us a realistic macro scenario next month.
So it says Brainard speaking. I don't know if she's going to speak on Monday. Would she talk about policy and stuff, or is that not discussion on it?
So we have a few speakers: Brainard, Barking, Williams, Mester, and Bostic. I think, I think they are all going to sing on the same tune that won't expect cuts. I think we see what they really think next month when we see their SCP. But otherwise, I don't expect anyone in this group of 5 speakers to speak for Joe Stiglitz. So I think they will stick to the party line.
Oh, I think one of the things that Jeremy Siegel was saying, that it's a very unique, in his entire career, he's never seen an economy or the U.S. economy where growth was around 0 and yet the labor market was so strong. So he thinks that maybe there's other things going on. I don't remember, but it was like something like that.
So again, it's most likely it's a statistical quirk, because there are 2 ways of measuring growth. One is to look at the production side, which is the GDP, and the other one is to look at the income side. And in principle, both should be the same, but actually the income side is much higher and much more consistent with the labor market than the production, so the GDP side. The other thing I would add is that in the US, there is a law called Okun's Law, which basically says that for a 1% decrease in unemployment relative to its long-term trend, you need a 2% increase in GDP. And that law has been extraordinarily stable. In fact, the president of the San Francisco Fed, when she was the head of research, wrote a note on the stability of this law during the GFC, where it looked like the law had broken down when it was actually GDP mismeasurement. And if you look at the decrease in unemployment, it suggests that growth is actually much stronger than what is measured by GDP. So, I mean, I am like totally open to the idea of being wrong and that growth is slowing, but I'm not seeing the data. I mean,
Right.
when I see the data, I'll change my mind. But right
Right,
now,
as you said, the hard data is still saying
sure,
pretty strong, and
definitely. And the soft data, I'm more and more of the view that the reason the soft data is so bad, expectations are terrible. I mean, if you look at consumer expectations, even some of the PMIs, they look like we are in the middle of a deep recession. And I suspect that what's happened is that we've had an unbelievable pandemic when the government, the Fed, just gave money to anybody who wanted it, as much money as you wanted, no questions asked. And so this made people really feel good. And now they are going back to earth. They have to earn their money. They have to go and do an unpleasant job to be able to afford a living. They can no longer rely on government handouts. They don't like it. And that could be why the soft data is so bad.
Yeah, interesting. Okay, awesome. Anything else for people should be thinking about next week or just in general?
No, I mean, I am hoping that we get a little bit of a break. I've been saying that all summer, but it's Labor Day next weekend. So I hope people have an uneventful week ahead of that. And, NFP that isn't too much of a shocker. That would be nice.
Great. Okay, cool. Well, thank you, everyone. Good luck to our investors, and as always, please reach out to us in any way we can help. And good luck this week.
Yeah.
Thank you. Thank you, Dominique.
Good luck, everybody. Thank you, Andrew. Bye.